Pierre-Paul here. Welcome back to another episode of the Canadian Multifamily Investing Insider Blog. Listen, in today's post, I want to talk about or answer a question that was asked of me by actually a couple of students of mine in the online course. As you know, I provide live workshops as well as my training program in the online format as well. And it's a great question, which I get a lot, and it's an important question. So the question goes like this. If a building is overpriced in a realtor's listing, how do you figure out the maximum amount you would pay to make it a worthwhile investment? Again, great question, and I'm going to answer that question now. But here's the thing. There's no perfect answer or no answer that fits everybody, right? It depends on your investment goals. Each investor will be different on the investor's investment horizon as well. All right, are you looking for a quick return, which is rare in multifamily? As you know, it's usually longer term stuff, 7 to 10 years. I would say 10 years is a minimum for you to stabilize the property and all that. But there's a few aspects to the answer. First of all, you never rely on the value that's in a realtor's pro forma. No offense to the realtors out there, but it's you're in it for the commission. It's understandable. So you can only rely on a valuation that's arrived after careful analysis, and that's what I want to talk about. So you cannot rely or should not rely on the realtor's pro forma, although if it's a specialized multifamily realtor, which you should only work with, not somebody that's never done a multifamily deal, normally they can give you a bunch of listings for the type of property that you're looking for and the size of property that you're looking for, so you can see what they are listed at. So that starts to give you an idea of the kind of values in terms of listings that are out there for the type of property that you're looking for. However, those are listing prices. They're not sales prices. That's really what will tell you, what the values are for the type of property that you're looking for. Secondly, I always put a lot of emphasis with my students in my workshops, in my online training program on the planning and research phase of investing in apartment buildings. First of all, you need to choose a market where you know that the fundamentals are good, that you're going to get some good value appreciation, low vacancies and all that, where the fundamentals in your market are strong. But you need to research that market, and then you need to choose a property type, as I mentioned, and a property size. Now, let me talk about the property type. Property type is it a ready project where there's no work to be done? It's already performing at maximum capacity. It's been stabilized, or is it a value add-on type of project, meaning that it needs some work, it needs some upgrades, maybe the vacancies are on the high side. So you need to go in and fix that. That's what we call a value add, because by doing that, you can probably increase your rental income and maybe lower your operating expenses, thereby increasing the value. So that's what we call a value add, that needs some work to increase the value of the property. All right, so once you've decided, and the property size as well, right, depending on your capital available to make that acquisition. So once you figure that out in your mind, you search in your market for properties that match those criteria, all right? And you need to know, when I was saying earlier, researching your market means that for the type of property and size of property that you've selected, what are they trading at currently in your market area? Oftentimes we look at the value per door. You can look at also the average cap rate. So the idea is that for the type of property that you're looking at acquiring, try to find an idea of the range of values that these properties are trading at currently in the market. So that's why you need to get a bunch of comps or comparable properties. They're actual sales, not just listings. They're sales that took place, that closed, that are, for comparable properties to that of what you're looking at buying right now. And when you look at the price, the purchase price or the value, you're trying to make sure that it's within that range. It's not a perfect science. If you've heard me say this before, the valuation method is the income valuation method that is mostly used for apartment buildings. It's not an exact science. There's a lot of subjectivity. But what you're trying to establish is that the price that you're looking at buying that property at is within the range for comparable properties. Then you got to start making some price adjustments up or upwards or downward based on specific characteristics for the property you're looking at buying. For example, if in terms of the type property, it is a concrete property, that's worth a lot more money. So you got to be willing to pay more for a concrete property versus a stick built, like a wood frame structure, property, which is worth less. Okay. You got to maybe pay more for a property that's in a greater market area, a greater neighborhood, in higher demand with lower vacancies or closer to transportation amenities and all of that. Maybe suite size or year construction. If it's a newer building, it's obviously you should be able to, you should be willing to pay more for a property that's newer and all of that. So you start making prices adjustments in that regard, all right? Then at the end of the day, also numbers have to work. Once you plug in, you decide how much financing you want to get, your loan to value. Then you plug in your income and expenses, you calculate your NOI, and then you determine the cost of money, what the interest rate will be for the loan amount that you're seeking to finance, and do you have a positive debt coverage ratio, right? For example, CMHC is 1.3. DCR is a minimum requirement, 1.25 for conventional lenders. In other words, does my NOI, my net operating income, cover my annual mortgage payments and some, so that you end up with also a positive cash flow. So not only should it cover your annual mortgage payments, but you should be left with a net cash flow at the end of the year. So if you can't make these numbers work, then you know that you're perhaps overpaying for the property. Now, finally, one last thing on the value, the purchase price of a property, I don't want you to lose sight of. There is always an opportunity cost to any deal, right? What's the cost of you not buying that property? Sometimes you got to overpay if you want to be in the game of investing in multifamily properties. And I think all of us seasoned multifamily investors at one time or another, we have overpaid for properties because either we knew we were in it in the long run, that the market would take us and the property would appreciate and would pay the principal down, or there was something in the market that would turn around, or you could go in and fix it, another value add type of project where you can go in and improve income and reduce operating expenses, thereby boosting valuation. All right. I have a lender that always says, he who gets the property is the one who overpays. I remember vividly one property that I overpaid by about $5,000 some years ago, and I've had it for almost 10 years, and it's done us very well. We've already been able to pay my investors half of their capital, all of that. So, but at that time when I got the appraisal back, it was about $5,000 per door over the appraised value, but I knew where the market was at in its cycle. It was in an ascending market. But I'm very glad I could have said, no, I'm going to pass on that property. And today I'd be very sad if I had missed out on that opportunity. So keep in mind the opportunity cost is also a factor to keep in mind when you determine what price you're going to pay for a property. So listen, folks, just a heads up, I have another workshop coming up at the request of popular demand in Hamilton, November 1st to the 3rd. I was not expecting to have another one this year because I had one last spring, but there's popular demand. Click below if you want to avail yourself of the early bird pricing. And in addition to that, I hope to see you at the Wealth Hacker Conference on November 9 in Toronto with Grant Cardone, organized by my great friend Erwin Zito. Bunch of great friends. We're going to share with you a lot of hacks, how to make money in real estate investing. If you want, and if you put in the coupon, which is the word Matterhorn, which is the name of my property management company, the Mountain in Switzerland, you can get a discount on the price of the ticket to the Wealth Hacker Conference in Toronto, November 9. Click below if you want to get that discount. So thank you for watching. Hopefully you found this post instructive. Cheers.